Good morning, students. How are you all? Hope you all are fine. Very good, students. Okay, shall we start the class? Okay, get ready with your notebook, your accountancy notebook. Okay, and I hope you remember the previous classes about the introduction of accounting, and the introduction I have explained to you. Then the evolution of accounting, how it came into existence. Okay, how it was evolved, when in the history it was evolved, the accounting. Okay, that we have studied, and in the yesterday's the day before yesterday's class, the evening intersession class, I have taught them. Okay, only 3 students have attended, nobody else. Okay, so once again I will explain that one. Okay, there in the evolution we have studied about that in the that Kautilya here in his book Arthasastra. This accounting has we could trace out some of the accounting procedure. Okay, but after this one, in 1492, in 15th century, one Italian merchant called Luca Pacioli, he introduced the double entry system in the world. Double entry system means, you will learn in future, that means we will enter both the aspect, that means the debit aspect and the credit aspect of a transaction will be recorded. Okay, that one was introduced in the 15th century. Then after 2 centuries only, the large scale production came into existence. That means the industrial revolution in European countries, it was developed. Okay, so it took place, the industrial revolution. In that one, they have produced the goods in large quantity. Large scale production came into existence. So that time only they realized the importance of accounting, because they were not able to remember all the that production and sales, because it was in large scale. If it is very less, they can keep in memory, isn't it? But if it is on large scale, they found it very difficult. So that time only this accounting has been introduced. It has developed. Okay. That time they have prepared the, they have followed the financial accounting. That means they want to find out whether they have earned any profit or loss. Okay, whether they have earned profit or loss. So they prepared this trading and profit and loss account. Then to find out their financial position, they have prepared the balance sheet. Okay, so that is called the financial account. Then along with this one, to price the product, they have to find out the cost. What is the total cost of the product? Only then they can price the product, isn't it? What is the price? Cost plus profit. Some profit they will add. Okay. So in order to calculate the, in order to fix the price of the product, this accounting came into existence. Cost accounting. Okay, that will find out the cost. Then the next accounting is the management accounting. This accounting came into existence only in the 20th century, the last century. Okay, because they might have appointed many managerial experts to manage the business. So with the help of the financial accounting and the cost accounting, they will analyze and why that difference, what is the fixed cost, what is the variable cost. Okay, and they will analyze and they will give interpretation. That means the explanation why there is increase in cost or increase in expenses, why there is a reduction in profit. Okay, for that purpose this management accounting has been evolved. Okay, so after this, in this century, the 21st century only, the social responsibility accounting and human resource accounting came into existence. This one is social responsibility, because each and every organization will be established in the midst of a society, isn't it? There, because the human resources are there. Maybe who are the human beings? All the employees. Maybe the skilled employees, unskilled employees, and the managerial employees. Then the customers, then creditors, then bank. They are also the human beings only are dealing, isn't it? Then the public, okay, as a whole, and the society where it is situated. So that each organization has some responsibilities towards this society or for the human resource. Okay, so that accounting also came into existence only in this century, 21st century. Okay, that was the evolution of accounting. Now we will learn the meaning of accounting. Okay, what is the meaning of accounting? So what is it? Accounting is the systematic process. Okay, systematic process of identifying. That means they will identify the transactions. Okay, and they will measure. That means what is the amount they will write. Okay, that is identifying, measuring, and they will record in the journal entries. Okay, this one, the third lesson you will learn recording. Then after recording in the journal entries, they will classify in the ledger accounts. Okay, that is called classifying. They will prepare the ledger accounts. That is called classifying. Then summarizing. The balances of the ledger accounts will be posted. They will be written in the summary as trial balance. That is summarizing. Then along with this one, with the this trial balance, they will prepare the trading and profit and loss account to find out the profit or loss. Okay, then the financial position they will ascertain with the help of balance sheet. Okay, the financial position, how much is the assets, how much is the liabilities, that is everything together called summarizing. Then that accounts will be given to the management. They will interpreting. Okay, they will analyze and they will interpret. And that one, along with the interpretation, their report, their summary, this financial statement along with the manager's report, it will be sent to the various users. That means communicating. Okay, what they will communicate? The financial information. The financial information, not the quality information. Okay, only the financial. What is the finance? What is the profit? What is the purchase? What is the sale? So the financial information is sent to the users. Okay, so it is, accounting is a systematic process. Okay, that meaning will be, meaning is given in the notes itself. Okay, I will show to you at the end of this class. So from this we can analyze what they do. What is the meaning of accounting? So the resources available. What are the resources available? They will calculate, and how these resources are employed. Okay, that is another one. Next step. Okay, how it is employed, whether it is employed, whether it is performed well. Because if it is performed well, they will get the profit, or it will be a loss. Okay, the resources available and how it has been employed. That is, with that one they will find out the result, that is either profit or loss. Then one definition also I have given in the notes. Okay, one definition is there. It is an art of recording. Okay, this definition is given by the American Institute of Certified Public Accountants. Okay, accounting is an art of recording, classifying. Okay, that one, first one, identifying, measuring, not given. Okay, that first they will from the transaction they will record that transaction is omitted. Okay, so definition, accounting is an art of recording, classifying and summarizing in a significant manner. Okay, important manner. Okay, significant means it is important. Important matters only will be recorded, and in terms of money. Those transactions will be entered in terms of money only. Other money, money transactions cannot be entered. then money, transactions and events which in part or at least of a financial character, which can be entered, recorded, all the transactions and events which can be expressed in terms of money. That is the meaning. Okay, and interpreting the results thereof. And they will interpret the result means the last one. They will prepare the financial statement and the management will interpret the results. Okay, that is one of the definition. Another one definition is also there. Okay, American Accounting Association. American Accounting Association has defined accounting as the process of, it is a process, that is what we are going to learn in the next video. Okay, process of identifying, like the first meaning, isn't it? Identifying, then measuring, together, everything together given, measuring and communicating. Measuring means everything coming together. That means recording, then classifying, then summarizing, everything together they have given us measuring. And communicating, what they will communicate? Economic information. That means the financial information we studied, no? That one. Economic information to permit informed judgments. Informed judgments. They will judge how much is the profit, how much is the financial position, that one. And judgments and decisions. They will decide. Okay, that management interpreting the results thereof, that one. And decisions by users of the information. Users you will study in the same lesson, who are all will use the financial information. Okay, not only the owners. Accounting is it is a process. Okay, that only one work, a series of work, continuous work. First one, identifying, then measuring and communicating what? Economic information. For what? To permit informed judgments. Okay, for this purpose. Informed judgments and decisions by whom? By the users of the information. Okay, that is the two definition and one meaning. Okay, that I have given in the notes. Now today's portion we will see. Okay, very little portion I have taken, only one heading. Okay, accounting cycle. It is we know that accounting cycle I have explained already. It is that process will be carried out at the end of the business, isn't it? As long as the business is there, this accounting preparation of accounting also will continue. Okay, that's why we call it as accounting cycle. Every year they will enter, they will identify the transactions, they will measure, they will record in the journal entries and they will post them. That means preparation of ledger account. Then the balances of ledger account will be taken to the trial balance. Then trial balance the items will be used in the preparation of that trading account and the profit and loss account, then at last the balance sheet. Okay, so again the balance sheet items, that will be the last date, what is the financial position of the concern. So the next year that items will be the opening balance and they will prepare the next year's, then they will continue with again identifying the transaction, measuring them, then recording them in the journal entries and then posting. Okay, that means classifying. Okay, it will be carried out every year. So it is called accounting cycle, again and again. So we can say accounting is a process. I told you it is a process. In the definition itself, accounting is a process we study. Okay, so many steps are there. What are the steps involved in the accounting cycle? So just again I have explained many times. Even then, now we will write and see. Okay, the first step is identifying the transactions. First one, identifying the transactions. And journalizing. This one we will learn in the third lesson. Third lesson is preparation of journal entry. Okay. So identifying the transactions and journalizing. I have told you many transactions will take place. All the monetary transactions that can be measured in terms of money, that is called monetary transaction. So they will calculate the amount of each transaction. For example, how much we have purchased on credit or how much we have purchased on cash. So it will be, we will write cash purchases rupees 10,000. Okay, so that if it is measured in terms of money only, we can write that, we can record them in the books of accounts. Okay, so they will identify first all the transactions. Okay, the transactions, different activities. I have taught you already what is the meaning. The simple meaning of transaction is activities. Trade activities, business activities, purchasing, selling. Okay, then for purchasing on credit, selling on credit, purchasing on cash, purchasing on selling on cash. Okay, then depositing money into the bank, then withdrawing money from the bank, or paying expenses, different kinds of expenses. Okay, direct expenses, indirect expenses, then office expense. Okay, then payment of expenses or receiving income. Okay, then all these will be identified. Okay, then they will journalize. Journalizing means journal entry. We call that journal entry. There we are going to learn in that lesson only the double entry system. Double entry system. That Luca Pacioli he introduced double entry system. That means we can say for each transaction there will be two aspects. You are going to learn in the third lesson all these things. Okay, so that is called, one will be debited, the other will be credited. That is called journalizing, preparing journal entries. Okay, journalizing means preparing journal entries for the transaction. So one will be debited, the other will be credited. Then second step, posting and balancing. Here, after preparing journal entry, what we have to do? We have to post them in the ledger accounts. Okay, ledger accounts. That is called posting and balancing. So, journal entry will be there. So, shall we write one journal entry here? Okay. So, purchasing for cash. Okay, purchases. Then we have to write purchases. That is one expense. Isn't it? Purchase account debtor to cash. The same 10,000 we will have. So now we are going to post these two aspects in the ledger. Both the account we have to post. First we have to post in the purchases account. Purchases account we have to take two pages. Okay, here one page I am using. Here debited. So debit side we have to write to cash. Then the amount column we have to write 10,000. Okay, either we have to find that we have to post them. Then cash account will be posted. Okay, cash account. For each ledger they will use one page. Okay, so the cash account, cash is credited. So credit side by purchases account. In the amount column we should write 10,000. Okay, this is called posting. Then we may write many items. Okay, here one item, here two item, three item. Okay, here and here many item will be there. Then we should add both the, that is called balancing. Okay, here okay 50,000, here 5,000, here 50,000. Okay, here 5,000. Okay, here 40,000, 50,000. Here it will be the balance. Okay, balance carry down. By balance carry down we will write 10,000. Then it will be written to balance brought down 10,000. Okay, so this will be total. We will total both the side. This side is called debit, the other side is called credit. Credit side and debit side totals will be added and it will be balanced. That balances will be written in the third step. That is called preparation of trial balance. Okay, preparation of trial balance. So the trial balance we will write. Trial balance one statement, only one page we will use. Okay, here we enter all the balances from the ledger accounts. Okay, all the ledger account balances will be summarized in a statement. That is called, we call summary, summarizing. Okay, so here purchases account we will write purchases debit. Okay, here debit balance, so 10,000. Cash also will show debit balance only. So okay, 10,000. Okay, then sales, it will come on the credit side. So we will prepare the trial balance. The total will be same. Okay, the total of the trial balance should get the same amount. Only then we can conclude that our calculations are correct. Okay, so what is the purpose of preparing this trial balance is to check the arithmetical accuracy. This is called arithmetical accuracy. We studied already. Okay, the arithmetical accuracy of the accounts are checked with the help of trial balance. So okay, 20,000, 20,000. Okay, then we can conclude that our calculations are correct. Okay, that is the third step. Third step involved in the accounting cycle. Then the fourth one, preparation of trading account. Then with the help of ledger balances we will prepare the trading account. Here we will use trading account. We have to use 2 pages. Okay, trading account. Here each and every step is one page, one lesson. Okay, so trading account we will use what is the opening stock, what is the purchases. Okay, then all direct expenses. This one you have to remember when I am teaching this trading account. Okay, around 11th, 12th and 13th lesson. Okay, that time you should remember. Then credit side we will write the sales, then the closing stock. We will find out the balance. Balance will be the gross profit. Okay, if the sales more, we will get gross profit. If the purchases more, sales less, we will get gross loss. Okay, so from the trading account we will calculate the gross profit. Okay, we will use the direct expenses. Okay, with the purchase and sales. Difference between sales and purchases. We will get the gross profit. Trading itself meaning what? Purchasing and selling. Is it? That's why purchase sales. Okay, the difference between the purchases and the sales, that is called the gross profit. So that account that we prepare is called trading account. Then the next account is called profit and loss account. Then here also we use both the pages. Okay, profit and loss account. Here this gross profit will be carried down here by gross profit. Okay, we will write. Then all the indirect expenses will be written on the debit side. All the indirect, that means the office expenses, administrative expenses, okay. Then selling expenses and distribution expenses. All these expenses will be written. Some that interest on capital, that adjustment will be there. Okay, interest on capital, interest on drawings. Okay, here any income, indirect income. Okay, interest on capital, interest on drawings. Okay, then dividend or rent, anything if we receive, that will be considered as income, and that will be entered on the credit side of the profit and loss account. The balance will be the net profit. That is the profit for the year. If this net profit, either net profit or net loss, we will get. Okay. So the next step, the last step is preparation of balance sheet. Balance sheet also we will use 2 pages. Okay, assets this side, assets right side, here liabilities. This one we will prepare for 1 year, but this one on the last date of the year. Okay, that particular date we will prepare. What are the value of the asset and what is the value of liabilities we will enter. That is called the financial position of the business. So financial position of the business can be ascertained from the balance sheet. So this is prepared at the end of the financial year. Okay, last date of the financial year. So these balances will be written as the opening balance in the next year, and again they will continue the next step. The balances of these assets and liabilities will be taken as the opening balances of the next year, okay, next financial year, and with that they will continue the next year's transaction, that journal entry. Again next year they will prepare journal entry, they will post them in the ledger accounts, then they will, from the balances of the ledger accounts, they will prepare the trial balance, and with the help of trial balance again they will prepare trading account, profit and loss account, and balance sheet. Okay, that is the called accounting cycle. It will be carried on continuously. Okay, students, I have taught you. I will show you the notes now. Okay, that first lesson. First one, 2 mark. Define accounting. 2 definitions given. Okay, first definition, Institute of Certified Public Accountants. Then next one, American Accounting Association. Okay, these 2 definitions you have to write and keep. Then 3 mark, meaning of accounting. Okay, since it is 3 mark, along with the meaning I have added these 3 points. Okay, so that one you have to write it down. Then today's portion, what are the steps involved in the process of accounting? Only you have to write all the 6 headings. Okay students, I think you will learn these question answers. Okay, so update yourself with the daily lessons. Okay students, and be safe at home. Thank you students.